this is slightly particular to emerging markets, but in EM, because of a relatively nascent financial market in many of the countries, there's a lack of what we call duration, so ability to issue long-term debt locally. You tend to find companies use US dollar loans to fund local currency investment projects, local currency assets, and so they borrow in a low cost of capital country like the US at 2% type rates, and they invest in local currency assets where there's sort of an 8 or 9% type interest cost. To me, that's a major red flag, because it's something which is outside of the control of the management team. When the local currency into which they've invested weakens, it significantly impairs the ability of the business to fund the requirements of the balance sheet, and that for me is not, no part of genius of the management team to do that. They've just put in place a carry trade, which any currency trader can do, and so I think that's definitely an area that I look to avoid. It adds instability to the business, and it just creates exogenous risks that can lead to permanent losses of capital for us, the minority shareholders, that are not something we can engage actively and proactively with the management team on. Ultimately, a balance sheet should be there to serve the operations of a company. Okay, it should have the ability to help the company invest across cycle and support the business when the operating environment is challenging. When you put in place either too much debt or debt in different currencies where it's not matched against cash generating assets, you can end up in a scenario where the operations have to serve the balance sheet, and that can become quite a dangerous position to find yourself in, particularly in countries which have got volatile political backdrops, volatile economic backdrops, and therefore volatile cost of funding locally and volatile currencies. And I've seen multiple instances over the last 12 years where what looked to be a very healthy balance sheet rapidly deteriorated because of US dollar losses on their debt that wasn't able to be compensated by gains on the asset side, and it led to major write-downs of shareholder wealth in a relatively short space of time, from which there is no comeback. And ultimately, my whole approach to investing is about managing downside risk and then investing in companies which have a range of possible outcomes to the upside, and that's a real red flag. The other red flags would just be aggressive accounting recognition policies, so aggressive revenue recognition, growth in working capital which looks disproportionate to the profitability growth of a business. That can indicate that a company is being aggressive in terms of how it sells product, leaning on suppliers or distributors too much, and actually trying to inflate near-term profitability and P&L metrics at the expense of balance sheet and cash flow metrics, which will come to the fore over the longer time horizon. So it's really a risk mitigation tool. Yeah, so there's a few different approaches. I actually work quite closely with a group of forensic accountants, which can help me to spot these red flags. They are experts. I think it is important to use a third-party group who are independent to the research process. They're not close to the stock. They often don't even know what the company does. They just take the audited statements, analyze them, and look for anomalies. One of the telltale signs actually is an average interest charge, which implies a cost of debt far in excess of the reported period end net debt position. So that can suggest that there's debt that's being pushed off balance sheet at the end of the reporting period to flatter the financial statements, but actually it's there during the reporting period. The other one, which is slightly more nuanced, is that we'll look at audit fees. So what percentage of revenues does a company pay for its audit versus global peers, and does that look anomalous or not? Can that suggest that auditors are maybe being lent on and offering other services that may reduce their impartiality when it comes to signing off accounts? How well widely acknowledged, respected is the auditor for a particular company? They're one or two other things that we look at. But in the main, I'm looking for mismatches, just things that are anomalous in the form of predominantly working capital and financial leases versus the P&L profitability metrics which get presented.